Hello and welcome to our next NAP. NAP stands for Nonprofit Auditor Points, and I'm Irina Oshkova, your nonprofit auditor. Welcome once again. Let's continue our series about explanation what we as the auditors looking for when we're testing expenses. And what you as a nonprofit need to make sure to be prepared for the auditor when the auditor testing expenses. When auditor looking at expenses, first of all, we do not test 100% of all the organization expenses. We don't have time and we're not required to do that by standards. We randomly or haphazardly make a selections on expenses that we're testing. But before we do that, we need to understand the structure of your expenses. We'll look at your general ledger of each expense account and see, first of all, that they agree to trial balance. The total GL number agree to that total trial balance. Then we see if your expenses overall tell us a story, if there's anything unusual. For example, if we see that the organization does not have vehicles, we know that the organization does not have vehicles, but we do see vehicle-related expenses. Or if we see that organization, we know that organization works with gorillas, but we see, for example, line items that call dog food. So anything that kind of does not fit the story or we don't understand what's going on, we're gonna ask as auditors, nonprofit, why you have this kind of expenses. They either unusual in nature, does not fit overall story, or we don't even understand what they are. So we're definitely confused we definitely cannot understand if we see accounts that called other expenses and they vary material, big expenses, or we see something as a miscellaneous expenses, or we see something that called personal expenses. All of that does not fit the story, does not explain, because our job as accountants make sure that expenses recorded in a proper period and they are necessary and reasonable for operating activity or other type of activities of the organization, and they fit the story. And they do belong to the organization. They cannot be personal, right? So reasonable and necessary. So then what we do, we make a selections for expenses to test. We typically select expenses that material, meaning big, large numbers, and we select expenses that either support material accounts or unusual, as I mentioned before, and expenses that recorded maybe at the end of the year or something one-off, something that really can cover all the bases. Material, unusual, we don't understand what they are, and so forth. When we test these expenses, what we're looking for, we need to see very often the minimum invoice. If we as auditors do not test internal control of the organization, we need to see invoice. And when I'm saying invoice, we need to see external vendor document. Sometimes nonprofits provide us some internally created bill. That's not sufficient. It's not sufficient audit evidence. We cannot audit the adequacy and properly, accurately record invoice based from invoice from your accounting system. We need to see external invoice. An invoice should clearly outline the date when the service or goods were provided, need to outline what it was for, and it needs to indicate that invoice belongs to the organization. It should not be on the name of any other entity. It needs to belong to the organization. So we as the auditors will look at all of this to make sure that the invoice recorded in a properly general ledger account. If it's travel expenses, hotel, it should be in the travel expenses. If the amount on invoice needs to agree to the amount recorded in general ledger, and the date. Date is very critical. If your organization year end is June 30, we need to make sure that services took place, organization received services before June 30. For example, cutoff is that's called cutoff. So we do as auditors, one of the most important tests we do is subsequent disbursement test. So what we do, we go to your accounting system, your bank statements, and we select invoices, that payments that were done after year end. For example, if your organization year end is June, we select payments were made July, August. And we're asking copies of the invoices. So we receive the invoices and we see the dates on those invoices. Were they provided before June or after June? So if they were before June, they should have been, we call it accrued, meaning recorded as accounts payable as of June 30. If the services or goods were delivered or provided after June 30, they would not be part of the accounts payable as of June 30. So it's called subsequent disbursement test. And a lot of times we do find that nonprofits do not accrue all necessary invoices for the services or goods that were delivered or provided before June 30. So how nonprofits can make sure to capture all invoices for the June 30 and record them as of June 30. My recommendation is to keep your books as of June 30 opened for a couple months, and even after June 30, every invoice that comes to the organization needs to be properly reviewed and see if it was for the time before June 30. It needs to be recorded in accounts payable as of June 30. It needs to be captured as of June 30. And typically by 2 months, all invoices for the year end should been received. So subsequent disbursement, it's critical because invoices typically delayed, but the services or goods were delivered or provided before June 30. And that's where a lot of auditors we keep our attention to. If we do see a lot of mistakes in expenses, specifically, if we see that expenses not recorded in a proper period or not in a proper general ledger account, misclassified, it indicates to us that there is not good internal control around expenses. And we, as auditors, have procedures that require us to understand control around expenses, how invoices come in, who approves invoices, how invoices gets recorded and reconciled to make sure that all invoices captured on time. If we see a lot of mistakes done, it means that organization either does not have internal control, maybe one bookkeeper does it all, and maybe she lacks some knowledge, or there's procedures, but it's not effective, meaning it's not working. So we will talk to nonprofit, advising them what they can do in order to mitigate these mistakes and lack of internal control. Maybe they can have a consultant to work with them and review the expenses on a quarterly basis, or maybe there is a board member who can volunteer and help them out. But that's an indicator that something is not working properly. Another thing that we see sometimes as auditors, nonprofits record expenses as adjusting journal entries. It's a bad practice, not advisable, because that's not testable. You do not understand how to verify that this adjustment is correct. Once adjustment, but it really is adjustment, absolutely legitimate. Nonprofits will have adjustments on the books, but expenses should not be recorded as an adjustment, because there has to be invoice associated with, an invoice needs to be related to vendor. It's properly to each invoice to have a vendor. So first of all, nonprofits can track which vendor they still have to pay for, and external or external auditor or even internal management and board can review where nonprofit pay money. So if your nonprofit use adjusting entry, manual record expenses, that's not a good practice. It needs to be done in record of invoices. We also see sometimes there's bookkeepers who are external bookkeeping firm that does books for nonprofits, and what they do, they record some expenses based on email from the client or some other support, but not invoice. Highly recommended, regardless even if you're outside bookkeeping firm or inside bookkeeper, to keep integrity of the books. There needs to be policy and procedure implemented inside nonprofit where you require for each expense to have proper invoice from outside third party that properly approved. Now, sometimes there are also expenses paid to or from a related party, maybe a related LLC that nonprofit created, but they independent, but they related, or even from the provider that related by marriage or just overall related to the some stuff in nonprofit. And you still need to have invoice from those parties, regardless who provided services or sent goods to nonprofit. It has to be supported by invoice, even if it's related party, if you know this vendor, even if they called you, and you still need to have a formal invoice. Because again, this is the way nonprofits can substantiate that this is a true, reasonable, and necessary expense for a nonprofit. You can substantiate it to the auditor, to your donors, to governmental entities, including the IRS, and compliance is a large, big issue for nonprofit organizations. Therefore, supporting expenses transaction, it's very critical. An internally developed document, it's not a support document. So the most common issues, once again, that we see in nonprofits when we test expenses, it's either missing documentation, missing invoices, misposed expenses, or misclassified expenses. They're not properly recorded in the various accounts. Unrecorded expenses, meaning accruals are not recorded, it's a cutoff. Or duplicate invoices, duplicate payments. One invoice was recorded without a number, then you forgot that it was recorded and you record it again. So very critically, to make sure that you maintain your expenses correctly, record them as invoices in your system by vendor, review them periodically, and make sure that each expense is supported from outside vendor invoice. Thank you so much. Looking forward to see you for the next step. Be safe and have a wonderful day. Talk to you soon.